The evolution of financial celebrity did not begin with social media, nor did it begin with charisma. It began with authority. In the early history of finance, the figures who were considered financial celebrities were not famous in the modern sense at all. They were bankers, industrialists, and power brokers whose influence came from proximity to capital governments and infrastructure. Their names circulated quietly in boardrooms and newspapers, not because they sought attention, but because their decisions moved economies. Fame was a byproduct of power, not a goal in itself. In the era of traditional banking and early capitalism, financial celebrity was inseparable from institutional trust. Figures like J.P. Morgan or the Rothschild bankers were known not for personal branding, but for stability. Their reputations were built on reliability during crisis. When markets collapsed or governments faltered, these individuals stepped in as organizers and guarantors. Visibility was limited, but authority was immense. Financial celebrity at this stage meant being indispensable. You were known because the system could not function without you. As markets expanded and public participation increased, particularly in the 20th century, financial celebrity began to shift from pure institutional power to individual identity. Investors like Benjamin Graham and later Warren Buffett became publicly recognizable, not because they controlled systems directly, but because they articulated philosophies that ordinary investors could understand and trust. Books, shareholder letters, and interviews became new channels of influence. Still, credibility preceded popularity. These figures became famous because they were consistent, not because they were entertaining. Their celebrity was slow, cumulative, and grounded in long-term results. The next major shift came with the rise of mass media. Television transformed financial figures into commentators and personalities. Shows on financial news networks brought traders, analysts, and fund managers into living rooms. For the first time, financial expertise was expected to be explained quickly and confidently, often in sound bites. This environment rewarded decisiveness and strong opinions more than nuance. Financial celebrity began to include performance as well as competence. Being right mattered, but being visible started to matter too. Even so, access remained limited. To become a recognized financial figure, one still needed credentials, capital, or institutional backing. The barrier to entry was high. Most viewers were consumers of information, not participants. The distance between the expert and the audience remained intact. Financial celebrities still spoke from above, even if the stage had become brighter. The true disruption arrived with the internet, and later with social media platforms. Blogs, forums, and eventually YouTube collapsed the traditional gatekeeping of financial visibility. Anyone with a camera, a screen, and an opinion could now speak about markets. Authority no longer required a bank title or a hedge fund track record. It required attention. This was a profound shift. Financial celebrity began to decouple from capital and reattach to reach. YouTube accelerated this transformation dramatically. Financial content creators emerged who had little or no institutional background, yet commanded audiences larger than many established professionals. They explained investing, trading, crypto, and personal finance in accessible language. For many viewers, these creators became their primary source of financial education. The relationship felt personal, conversational, and immediate. Financial celebrity was no longer distant. It was embedded in daily feeds. This new model changed the incentives. In the traditional era, credibility was built before influence. In the social media era, influence often comes first. Algorithms reward engagement, consistency, and emotional resonance. Educational accuracy, risk disclosure, and long-term accountability are harder to measure and often less rewarded. As a result, financial celebrity increasingly depends on storytelling, relatability, and confidence, sometimes more than on results. This does not mean that all modern financial influencers lack value. Many provide genuine education, transparency, and caution. But the structure itself has changed. The system now elevates those who can hold attention, not necessarily those who can survive market cycles. Financial celebrity has become faster, louder, and more fragile. Reputations are built quickly and can disappear just as fast when markets turn or narratives collapse. What is most striking in this evolution is that the definition of expert has quietly shifted. In the past, expertise was validated by survival through multiple crises. Today, it is often validated by audience growth. This creates a tension that did not exist before. Financial celebrity is now split between two worlds. One where credibility is earned slowly through results, and another where visibility is earned rapidly through communication. And it is exactly at this intersection where authority based on capital meets influence based on attention that the deeper implications of this evolution begin to emerge. Because the story of financial celebrity is no longer just about who controls money, but about who shapes belief, behavior, and expectation in millions of individual minds. And this is where the second part of the story truly begins. Because once financial celebrity becomes tied to attention rather than proven endurance, its impact on behavior becomes far more consequential than its entertainment value. Part 2 of this evolution is not about platforms, but about psychology. It is about what happens when millions of people begin forming financial beliefs not from lived market cycles, but from personalities who rise and fall within algorithmic timelines that are far shorter than any real investment horizon. In the modern attention economy, financial celebrity increasingly operates on speed. Content must be frequent. Opinions must be clear. Confidence must be visible. This environment subtly reshapes how financial ideas are presented. Uncertainty is downplayed. Nuance is compressed. Risk is often framed as optional rather than structural. In contrast to earlier financial figures who built reputations by surviving crises, many modern financial influencers build reputations before their ideas have ever been tested by a full market cycle. This creates a dangerous mismatch between perceived authority and actual experience. One of the most important consequences of this shift is the gamification of finance. Platforms reward excitement, transformation stories, and dramatic outcomes. Viewers are drawn to narratives of rapid success, personal freedom, and beating the system. Financial celebrity in this context becomes aspirational rather than instructional. The problem is not that ambition is encouraged, but that risk is often aestheticized. Losses are framed as temporary setbacks. Volatility is reframed as opportunity. The emotional reality of drawdowns, boredom, and long periods of underperformance rarely fits the content format and is therefore underrepresented. This stands in sharp contrast to earlier financial celebrities whose authority came from restraint. Figures like Buffett or Graham became famous precisely because they refused to entertain. Their lessons were slow, repetitive, and often uncomfortable. In today's ecosystem, that kind of messaging struggles to compete. As a result, the market's natural difficulty is softened in presentation, even as its actual danger remains unchanged. The cost of this gap is paid by beginners who confuse confidence with competence. Another major shift is parasocial trust. Traditional financial figures were distant. You read their letters. You studied their records. You did not feel as though you knew them personally. Modern financial celebrities, especially YouTubers, build trust through intimacy. They speak directly to the camera. They share personal stories, routines, and struggles. This creates a sense of relationship that can override critical thinking. Advice feels friendly rather than analytical. disagreement feels disloyal. When things go wrong, followers may blame themselves rather than question the source. This emotional dynamic did not exist in earlier eras of financial authority. At the same time, the democratization of financial voice is not purely negative. Many YouTubers and online educators have lowered barriers to entry, explaining concepts that were once locked behind jargon and institutions. They have empowered individuals to take interest in investing, saving, and financial planning. This is real progress. The danger lies not in accessibility, but in substitution, when entertainment replaces education and relatability replaces accountability. Financial celebrity becomes harmful not when it is popular, but when popularity is mistaken for proof. Another key difference in the modern era is lack of consequence symmetry. Traditional financial celebrities bore direct consequences for their mistakes. Their capital, reputation, and institutions were on the line. Many modern financial influencers bear limited downside. If an idea fails, content moves on. The algorithm forgets. The audience refreshes. This asymmetry changes incentives. Bold claims are rewarded. Caution is penalized. The system does not naturally favor those who are right over time. It favors those who are compelling now. This brings us to the most important distinction in the evolution of financial celebrity credibility versus influence. Credibility is slow. It is built through cycles, mistakes, and adaptation. Influence is fast. It is built through engagement, storytelling, and consistency. In the past, influence followed credibility. Today, credibility often tries to catch up to influence. This inversion explains why modern financial celebrities appear more numerous, more volatile, and more replaceable than their predecessors. For the individual navigating this landscape, the lesson is not to reject modern financial voices outright, but to change how they are evaluated. Instead of asking, "How confident does this person sound?" the better questions become, have they operated through multiple market regimes? Do they show how they handle being wrong? Do they discuss boredom, drawdowns, and inactivity? Do they discourage dependence on themselves? Ironically, the most trustworthy financial educators are often the least charismatic because they spend more time narrowing behavior than expanding excitement. The evolution from bankers to YouTubers ultimately reflects a broader shift in society. Authority has moved from institutions to narratives. Money still moves markets, but belief moves people. Financial celebrity today shapes not just portfolios, but expectations, patience, and emotional tolerance for risk. This makes the role far more powerful and far more dangerous than it appears on the surface. And so the story resolves not with judgment, but with responsibility. Financial celebrity is no longer just about managing capital. It is about managing attention and belief. Those who occupy this space, whether bankers or YouTubers, are shaping how millions think about risk, time, and effort. The evolution is not inherently good or bad. It is simply real. What matters is whether audiences learn to distinguish between voices that help them survive markets and voices that merely help them stay entertained while taking risks they do not yet understand. In the end, the true evolution of financial celebrity is not technological, but psychological. The platform changed. The human impulses did not. And in a world where influence travels faster than experience, the burden shifts to the listener to value depth over volume, endurance over excitement, and credibility earned through time. Overconfidence projected through a screen.